topic of the day is, can we have economically secure retirements? My name is James Choi. I'm a professor of finance at the School of Management, and this is a topic that is near and dear to my heart because I have done a lot of research on retirement savings, particularly in the 401k space, and how behavioral economics plays out in retirement savings and investing. And we have a great panel that is joining us today. Gerardo Guerra, Lori Lucas, and Mark Mayer. I'll have them introduce themselves shortly. But the purpose of my role here today is to basically let our panelists shine and to share as much of their expertise with us as they can in the hour. And maybe I'll also play devil's advocate from time to time as the occasion calls for. So why don't I begin with Gerardo? Can you give us a short introduction of yourself?
Yes, hi, I'm Gerardo Guerra, country manager for HES Mexico. I used to be director of compensation in Mexico and benefits for HES, and prior to that, director of compensation, vice president of compensation and benefits for CEMEX, managing retirement since probably 20 years ago on both the financial side and on the administration side, and pension plans in the US, Mexico, UK, and Spain. I'm a class of 96 SOM. That's pretty much it.
Thanks, Gerardo. Lori, you want to go next?
Sure. My name is Lori Lucas. I'm the Defined Contribution Practice Leader here at Callan Associates. And prior to my role at Callan, I worked at Hewitt Associates as the director of their retirement research and did a lot of great research on behavioral economics, where James factored in very prominently in some of the participant behavior work that we did while I was at Hewitt.
Yeah, Lori and I have known each other since at least, I think, 1999 or 2000, and I really am eternally grateful for her because without her help, I would have never gone down this route of researching retirement in 401ks. So thank you, Lori.
It was a lot of fun.
And Mark, you want to chime in here?
Sure. I'm Mark Mayer. I'm the head of North American institutions at Schroders. I've been in the investment management industry for a little over 25 years. And, I like to think that we've evolved from being an industry that thinks of itself as being in the alpha business to one that's more appropriately defining its role as being in the outcomes-oriented businesses. And the primary one is clearly helping people secure their retirements.
Great, thanks, guys. So just to give people an idea of what the format's going to be, I'm going to start off by posing some questions to the panelists, and those in the audience should feel free to type in questions for the panelists, and we'll see what comes in, and we'll take a few questions from the audience as well. So just to begin, throw this out to all the panelists. So from time to time, we read in the news media that American savings habits are just dismal. And I'm wondering what your perspective on that is. Is it really all that bad?
And I'm happy to start off with some survey statistics that I think paints a very interesting picture about American savings habits. The Plan Sponsor Council of America shows that 80% of eligible employees made contributions to their employer-sponsored defined contribution plans in 2013 with an average contribution rate of just under 7%. And what's interesting about that is when you poll plan sponsors of these defined contribution plans as to what they think savings rates should be of their employees, 82% said they thought it should be at least 10% of pay, not below 7% of pay. And a third said they thought people should be saving at least 15% of pay. But without the employer in the picture, things get even more grim. We find from the Investment Company Institute that only 12% of American households contributed to an IRA in 2013. So the employer is very important to American savings, although we see that there can still be a lot more done in that area.
Furthermore, I mean, I was reading James Poterba's analysis on half of Americans die with $10,000 or less in assets, which when you look at just how much medical care will cost, that is half of Americans having less than will be required for them to take care of a medical emergency.
Well, let me play devil's advocate here, though. So isn't there Social Security and there's Medicare, and so isn't it possible that those two avenues are providing enough of a cushion that even with a 7% contribution rate to your 401k plus an employer matching contribution, which might take you up to, I don't know, 10%, 11% total, that might not be enough?
Well, I'd say, the economics would argue that you really do need to be saving in excess of 15%. And as we look around the world, not just in the United States, but at other countries where I think the thinking has been quite progressive, Singapore is an obvious example, Australia, we often see savings rates well in excess of 15%. So I think if we have an optimal situation where an employee is putting the maximum amount in, the employer is matching it, that's getting to a total in perhaps the low teens, it's supplemented by Social Security, and we assume that the Social Security Trust Fund survives in perpetuity, perhaps we're getting to a situation where the employee can get to the desirable level of, let's call it 75% replacement of final salary for the entirety of retirement. That's an awful lot of pieces that really have to come into to play. And I think in the United States, we've been, frankly, less aggressive than folks in Australia or Singapore or many other places in ensuring that we get to a level of that magnitude.
Sure, and I guess another thing that I would add is that Lori had talked about contributions to 401ks, so these are people that are covered under employer-sponsored plans, but the 401k eligible population is something like, I think, half of U.S. workers, and so there's kind of a broad spectrum of the population that's not covered by an employer match, is not covered by some of the fiduciary protections and oversight of their employer when it comes to retirement savings. So I guess my sense of the literature is that there is, the academic literature is there's some disagreement about exactly how well the average U.S. worker is doing in terms of saving for retirement, but certainly there is concern among everybody for people in, say, the bottom 20% of the savings distribution that they may not have something that is sufficient to cover their needs in retirement. So if that's a state of things, it seems that to a certain extent, maybe that's self-inflicted in that workers should be saving more and they're not. And in the old days, a lot of that savings and investing decision was outsourced to a defined benefit plan. So an employer you would start working employer, you would work for them for 30, 40 years, and then you'd retire with a pension, and the defined benefit pension would send you a check every month for the rest of your life. And it was in some ways pretty automated and paternalistic. And nowadays we're moving to defined contribution pension world where most people are contributing to 401ks, and that's what's expected to provide for them, at least from the employer side, into retirement. So this is a question for Gerardo. So why did this change happen? Why are we in the DC world now instead of a DB world? And is that a good thing?
I will say it's not a good thing. If you look at simply the returns that you have on DB plans versus DC plans, it's a 200 basis points difference just because some are self-directed where the DB plans are actively managed. But why it changed? I think there's a combination of both regulation and demographics. When you look at regulation, prior to any regulation on the DB plans, there used to be 100% of Fortune 100 companies offering DB plans. My company, by the way, is one of the few that still offers a DB plan, and on the Fortune 100, there are today only 10% of Fortune 100 companies offering DB plans to their new employees. Why that happens? With the ERISA in 1974, there was a big reduction because it was more onerous for a company to maintain a DB plan. Then you had the introduction of 401k with the Tax Revenue Act of 1978 that helped ease some of the pain and gave an alternative to DB plans for companies. Then you have EXTERA, or the Pension Protection Act, that put further burden into companies and basically comes up a time where it's not sustainable from the regulation side. And then you look at the demographics. People that were born in the 1900s had a life expectancy of 51 to 58, depending if they were male or female. Someone born in the 2000s will have a life expectancy of 80 to 84 for males and females. So that in itself is with the same retirement age. So we haven't moved our retirement age from 65 throughout that period. It just creates so much more pressure into having a DB plan versus just train people to get a DC plan.
So we know that DB plans are becoming tremendously expensive to administer. Is there any good reason to have a DC plan instead of a DB plan? Are there any winners in this transition?
I was going to argue the case for defined contribution. The world has changed a lot in terms of the workforce, and most people, to Gerardo's point, do not work in the same corporation or the same organization for 30 or 40 years. It's a much more mobile and transient workforce, and one of the key advantages of a defined contribution plan is it is portable. And I think some of the disadvantages of defined contribution plans, and they have been disadvantaged, they have underperformed defined benefit plans for a variety of reasons, but some of those disadvantages are going away basically because the Pension Protection Act of 2006 made it much easier to DBIs 401k plans and other defined contribution plans by automatically enrolling people so that people are in the plans earlier in their career. They're saving longer. Their automatic contribution escalation gets people to higher savings rates. And then people are defaulted into professionally managed solutions like target date funds, which further can help reduce that, the differential between the performance of defined contribution and defined benefit. And further, fees. Defined contribution plans have been managed for many years like retail types of investments. They're becoming more institutionalized and using more institutional structures like collective trusts and separate accounts, which help reduce fees and improve performance. So the gap is narrowing, and I think that's greatly attributable to the Pension Protection Act.
So kind of getting on to automatic enrollment, and I know that, Laura, you've done a lot of work on this. A big question for an employer that wanted to automatically enroll their employees in the 401k plan is, what should the defaults be? So what contribution rate should employees be put in if they don't opt out? And also the asset allocation, which I want to defer to a later question, but what do you see as going into employers thinking when they set that default?
Yeah, so I'll tackle the contribution default because I think this is an interesting instance of some behavioral biases we're seeing among employers. Employers are people too, and they're subject to behavioral biases. And a number of times what I see is that employers are using rules of thumb in order to determine their default contribution rate for their plan, as opposed to really thinking about what the default should be given their population, the demographics of their population, and the requirements to get people to a certain outcome in terms of retirement income replacement. So some of these rules of thumb might be prevalence. What is the most prevalent default contribution rate? Well, 3%. Do people really think that they're going to get to a decent retirement outcome if they contribute 3% a year to their plan? Well, if they really thought about it, probably not. And one thing we know about automatic enrollment is that it works because of inertia. People stay in the plan in large part out of inertia when they're automatically enrolled, but they'll also stay at the default contribution rate. And if it's 3%, that's too low. And then the other bias that we see is a behavioral bias, is what I call this magical number thinking, that there's some magic to certain numbers, like a 3% default contribution rate, which is very common, or a 6% cap on automatic contribution escalation. And why are these numbers magical or considered magical? Well, there historically have been some obscure non-discrimination testing safe harbors that have been associated with those numbers. It really, for the most part, for most plan sponsors, those numbers are completely meaningless, and unless you are adhering to this, again, obscure non-discrimination testing safe harbor. But it's caught the imagination of plan sponsors, and we see these numbers over and over again, when in fact what they really should be doing is figuring out, if my employees need to have X% of retirement income replaced by the defined contribution plan, what do my defaults really need to be?
The one thing that I've also been reading about is maybe some plan sponsors are concerned about what their matching contribution expenses would be if they chose the higher default. Are you seeing much of that?
That's absolutely a reason, not only that we're seeing these low default contribution rates, but also plan sponsors only auto-enrolling new hires, creating a set of have and have-nots in their population. The haves are the people that are new hires. People that have been there for years and years and are not automatically enrolled are the have-nots. And there is a cost associated. It's a real cost. It's not an imaginary cost, but there are ways to manage that cost, including changing the match. There's been a lot of research, James, that I know you and others have done that have shown that when you have automatic enrollment in place, you can stretch the match and change the match in order to make it more cost neutral to the plan sponsor, and opt-out rates will remain pretty low because automatic enrollment is so powerful, it kind of trumps the match in terms of getting people into the plan.
So I guess one concern that I might have as a plan sponsor is if I stretch the match, so I make the matching rate less generous, but I make the threshold up to which the match goes higher, that maybe there would be anger among the employee population that you're made the plan less generous. So I'm wondering if you had seen instances of companies that did change the match structure, and if so, what was the reaction of the employees to that in conjunction with a higher automatic enrollment default contribution rate?
It can definitely be viewed as a takeaway to participants. A match, is still very important in a plan. And especially for lower wage workers who may not be able to contribute high enough to get the full match, that it could be a real takeaway, certainly. We have seen very little of that done in terms of stretching the match, so I don't have a lot of experience. But what I thought was really interesting was even when the financial crisis and the market collapse happened in 2008, and employers were completely eliminating the match, when they reintroduced the match, they reintroduced it just the way it was before. And that could have been a great opportunity for plan sponsors to think about restructuring the match. So I think it's more than participant concerns. I think some plan sponsors really need to sit down and do the math and figure out if it's how feasible it could be to stretch the match, and then deal with the public relations issues as they come, and not let that be a non-starter.
So if somebody in our audience were to join a new company, and they found that the automatic enrollment default contribution rate was 5%, how should they be thinking about that choice? Should they be thinking that maybe there's some advice from the company embedded in that default, that 5% is kind of a good place to be in the 401k contribution rate?
Unfortunately, I think that's exactly what we're seeing. That's another behavioral bias we see from participants, is that they're defaulted into a plan at a certain level, and they have no idea what they should be saving at. So they assume their employer is putting them in at a level that will get them to the right outcome. So there is, I think that the presence of automatic enrollment and even contribution escalation doesn't mean you should refrain as an employer from communicating and providing tools and help to participants in getting to the right levels. I mean, think about it from this point of view of again, this more transient workforce where people have 6-7 jobs throughout their career, and each time if they're automatically enrolled at 3% or even 5%, and then they get up to contribution escalates them, contribution escalates and gets them up to 10%. Then they go back to 5% or 3% with the next job. I mean, that's going to make it very hard for them to get to a good outcome, even with contribution escalation in place.
Thank you, Lori. So just for those in the audience who've joined us late, a reminder that you can send in questions, and we will come to them later on in the webinar. Let me turn to Mark and take the kind of the other half of the defaults in 401ks. So target date retirement funds have been a big a very, very popular default asset allocation in 401k plans in recent years. And so I was wondering if you could begin by just maybe describing what a target date retirement fund is, and how come these things have become so popular in recent years.
So target date funds have actually been around for a while, over 15 years. They've really become much more popular in the wake of the Pension Protection Act in 2006. So the explosion of target date funds is really in the last decade. So just to dimension it, in the total target date assets are something just north of $700 billion. Now, in the context of overall DC plans, which is in the neighborhood of $5 trillion, it's still a relatively modest component. But in terms of the net new money going into retirement plans, into DC plans, they really are almost the entirety of the net money going in. Right? So there's some money being paid out as benefits, and there are new contributions going in. And almost 100% of the net new money going into DC plans are actually now going into target date funds. So while they may be in the order of 15% of total balances, they are really almost the entirety of net flows. So they're very, very important. The essential innovation of target date funds, which Laurie already touched on, was trying to capture some of the basic thinking that has gone into thoughtful construction of pension plans over the many decades that we've had them now. And it's to try and address the behavioral biases of the plan participants by harnessing inertia in a favorable way rather than giving into destructive inertia. So the destructive inertia that could be seen in the balances that were prevalent in 401k plans, let's say in the early 1990s or the mid 1990s, was there was sort of a bimodal distribution with an enormous amount of money, a really disproportionate amount of money on the order of 20 to 25% that was in the stock of the company that employed, which is a bad idea for a number of reasons, and I'll touch on those. The other big distribution of balances was in cash and cash equivalents. So the problem with cash and cash equivalents is that they don't generate any real return above inflation. So that your purchasing power is just flat over a very long period of time, and that's a big problem. So if you have 20% in cash and cash equivalents, it's really not growing over the course of your career in real terms after inflation. The problem with company stock is that it's subject to enormous idiosyncratic risk. So as employers, we all feel good about our companies. We all feel that it has wonderful prospects. But the reality is we don't actually know. And the volatility of returns of any individual stock is very, very high, in excess of 20%. And so the possibility of your own company stock doing poorly is very, very high. And what brought this into really graphic relief was the bankruptcy of Enron, where an enormous amount of the 401k plan was actually invested in the stock of Enron, and the participants lost an enormous amount of money in that. So those were sort of bad behaviors that were sort of driven by inertia. I don't know what to do, so I'll invest in the company stock and I'll put it in cash because cash is safe. What target date funds have done is take the learnings of behavioral finance and say, well, if we ask the participant to only know one thing, and that is the approximate date in which you're going to retire. I'm 30 years old. I intend to work for 35 years. It's 2015, and so I expect to have a target date fund that's going to be called the 2050 target date fund. I don't need to know anything about stock markets. I don't need to know anything about bond markets. I just need to have an approximate sense of when I'm going to retire. And then a professional manager is going to control the allocation of that fund over time. And so this was a very, very big idea. It's not a perfect idea because there are many ways of addressing the allocation question, but it's an important innovation that I think has helped us. And this is why this has become the default of choice in the United States for retirement plans.
So one of the things that these target date funds all do is they have this equity glide path where you have more stock in your portfolio when you're young, and that kind of goes down over time. Could you speak to why having a lower stock allocation as you age is a good idea? What's the theory behind that?
So the essential theory is that as you near retirement, and then once you find yourself in retirement, that you are not in a position to replace what you might lose if there's a big downturn in equity markets that wipes out 10% or 20% of the value of your 401k balance. Right? So the way an economist would articulate this is that at a young age, the single greatest asset you have is your future earnings power. So it's the labor component dominates the value of your long-term savings opportunity. As when you're older, the labor component by definition is going down. Okay, I'm now 64 years old. I'm gonna work for one more year. After that, I'm not gonna work at all. Right? So I have no income from labor, from my job, and the only income I can have is from my retirement savings. And so if you have no ability to replace those lost wages because you no longer work or you're not going to work for much longer, then there's a great deal of risk, in theory, that you have to try and avoid by having greater exposure to fixed income. Now, there's some controversy about this, and that is, and Gerardo touched on this, that life expectancies are lengthening dramatically. And it's not just the life expectancy at birth, it's the fact that people who make it to retirement age have a really, really high probability of living a very long time. So it really now is axiomatic that a person in his or her 60s has to be planning for 3 decades or more without a paycheck. And those numbers are likely to just keep going up over time. And so in investing, when you have a very long horizon, and I think most of us would argue that 30 plus years is a very long horizon, in general, you need growth assets, and the most popular growth asset that one can own happens to be stocks. So there's a tremendous tension here between having to invest wisely for a very long period of time, even though I'm now at retirement age, but I also don't have the capability to replace any money that I lose from my 401k with wages that I'll make in the years ahead. So this is a complex problem, and frankly, investment managers and plan participants, plan sponsors, have come up with very, very different answers for the best way to solve this conundrum.
Yeah, so that's why I think that there has been some, I don't know if it's been in the popular media, but at least in academic research, there has been some scrutiny of the fact that these glide paths are quite different across these target date funds. So if you would take target date funds as a kind of a class, how have they done since they have become quite popular? Have they tangibly delivered these benefits to participants, or maybe is it too early to tell?
I think there's reasonably good data, and I know Lori and Callan have done some very good research on this, so she can speak to it as well. So let's just look at the last 10 years. So if we look at all different series of target date funds, so that's for people who think they're going to retire in 5 years or in 35 years, they've collectively generated compound returns of about 5.5%, which is reasonably good, but it's not demonstrably better than other choices that those plan participants had over this time frame. This has been a very interesting 10 years because we obviously had a global financial crisis in the midst of it. But the returns have been okay, right? Not widely divergent from long-term norms or long-term expectations. One of the good pieces of news, and Morningstar captured this in their recent report on target date funds, is that the results that have actually accrued to the investors have been somewhat better than the stated performance of the funds. And this has to do with the dynamics of the way investment companies, money management companies report results, which is what would be called time-weighted results. How did a certain amount of money, a flat amount of money perform over a period of time? Whereas what we experience as investors with 401k participants is how did my money do? And if I have more money over time, I'm really interested in whether the higher balances did better than the smaller balances. And what Morningstar found is that the returns to investors, the realized returns to investors, have actually been better than the stated returns of funds. And all this does is capture this critical, absolutely critical dynamic of sort of constantly putting money into your 401k every couple of weeks. That discipline, that process, that dollar cost averaging has been a powerful force for good and has allowed for some compound benefit to the participants. But let me let Lori talk a little bit about Callan's research on how investors have done in target date versus other alternatives.
Yeah, thanks, Mark. We've done a lot of research in that area. We have an index called the Callan DC Index, and we also have an index called the Callan Target Date Index, and we compare the results of both. So the DC Index looks at the performance of typical participants, large defined contribution plans, and we compare that to the weighted average performance of all the target date funds out there. And as Mark indicated, target date funds have not blown the lights out. What we find is that the performance since 2006, when we started tracking this, has been really in line. Target date funds have just about just kept up with the typical DC participants' performance. They have not outperformed, and both have underperformed defined benefit plans. So that's been something of a disappointment because the target date funds are held out as professionally managed solutions. So why has this happened? Well, the 2008 collapse was really tough on target date funds because target date funds take more risk on average than participants do, and that's probably a good thing. Participants tend to take too little risk for relative to what they should over time in order to get to reasonable outcomes. So the fact that they take more risk is not a knock against target date funds, but it really hurt them in 2008. And in fact, they had very stringent rebalancing protocols in place back then as well, by and large. So that as the market was continuing to go down, these funds were rebalancing back into it, which hurt them even more. So that, and we continue to see every time the market declines, the typical target date fund does tend to do worse than the typical participant. So the other thing that's worked against target date funds, ironically, is their diversification. Target date funds are much better diversified than the typical participant by and large. They may have things like alternatives in there, not a tremendous amount of exposure to that today, but more and more types of funds and investments that the typical participant would not have access to or be qualified to invest in. Mark makes the point about the performance of participants in target date funds being strong relative to even the performance of the target date funds on their own. Interestingly, when you look at that same Morningstar research on emerging markets equity funds, for example, the weighted return of participants is negative in those funds because they tend to market time them. They move into them when they're at their peak, and they move out of them when they're at their trough. And as a result of their market timing, emerging market performance is horrible for plan participants. And in fact, we would recommend you do not make an emerging market equity fund available to a participant because it's just too high octane for them in terms of the way they handle it. But emerging markets equity works very well in a target date fund, and there's no opportunity for participants to market time it. So it's a good option to have as a diversifier in a target date fund. Unfortunately, the market has just been in the past couple of years in a state where diversification has not really benefited too much for target date funds. So it hasn't helped them. So that's another thing that's hurt target date funds. We continue to see target date funds evolve and develop. And rebalancing strategies becoming more sophisticated than they used to be, diversification becoming better than it ever has been. And even though the average target date fund has not blown the lights out,
Lori, I think, so we've temporarily lost Lori due to technical difficulties. Let me turn it over to Gerardo for a second here. So Gerardo, at your company, have you guys had any experience with? Hi, Laura, you're back.
Okay, sorry about that. It said my internet connection was becoming unstable. Can you hear me?
Yes, you're back.
Okay, good. Yeah, so the other thing we learned in the financial crisis is just how divergent the performance of various target date funds can be. So it really behooves investors and plan sponsors to understand the glide path of their target date fund and the way it's being implemented, because we saw huge differences in the ability to navigate the market collapse in 2008, and those differences have diminished as the market has stabilized, but still really important to understand the characteristics of target date funds, because one thing they are not is a commodity. They are certainly different from each other in terms of the performance expectations.
So let me pick up on that question I was asking Gerardo when Lori went offline for a second. So Gerardo, has your company had any experience with target date funds?
We introduced them as a default for new employees, anyone getting into the plan is a default investment vehicle. I think they provide a very good diversification for employees, better than the average employee was doing prior to have them, because prior to that they pretty much had their money into a safe asset, if you can call a safe asset something that is not going up or down. That would be debatable. And now at least we know most of our employees, or about 75% of them, have a target dated fund. So in that sense has been positive. The problem is some people don't understand the target date funds, and one of the problems we see is that they use them as an asset class instead of as a final fund. So they will use it as 20% in this target date fund and 20% in each one of the other assets available to me, instead of using it as a strategy for retirement.
Well, let me move to one of the audience questions. We have a question saying, I would love to hear your perspectives on how you think the traditional employment and retirement benefits models might evolve as platform-based companies such as Uber gain traction and become bigger forces in the labor market. So I guess
I can take that.
Oh, go ahead.
I would say I like to see retirement as through the three-pillar model. You have the government, you have the employer, and you have the individual. All those are sources of retirement income. So in the sense that if you go to Uber and you become your own employer to certain extents, I see two solutions for that. Either the individual starts saving more because they are their own employer, although that would recommend that, I don't think that's practical. So the alternative will be maybe to have a platform-based retirement vehicle. Just as there's an Uber for people to get employment, there should be a Uber-type retirement platform that allow those self-employed to have a way to save for their retirement.
Yeah, so I think that this problem of freelancers and people in the maybe more informal economy and how to provide for their retirement is a vexing question around the world, because these are people who have kind of less of an umbrella from some technical experts to provide for their retirement. I was just in Chile, and Chile is, of course, famous for its pension system and the system of private accounts that they use in place of Social Security. But there's a big problem with the kind of the people in the informal economy who are not covered by the system. And so I think as we move, if we do move to a more freelance economy with Uber and Airbnb and other kinds of platform-based companies, I think this is something that may come into play. And I think that Washington is thinking about this in terms of creating auto IRAs. I think that you're seeing this also in some states like Illinois, California, trying to provide some kind of automation, some kind of at least guidance for people who aren't covered by the traditional 401k platform. Let me move to another question, which has to do with what Mark was saying earlier about increased life expectancy. So with people reaching age 65, having a very good chance of reaching age 90 or 95, running out of money, outliving your savings is a big concern. And the traditional rule of thumb has been that you can spend 4% of your nest egg each year and have a reasonably low probability of outliving your savings. But now we're living in an era where interest rates are close to zero. So do we need to revisit this 4% rule? And we're talking about sustainable withdrawal rates around 1% or less, then how can people sustain reasonable retirement?
I'll start off. I think this really it has a lot to do with inflation rates. It has a lot to do with expected returns in the capital markets. If we are spending at a rate in real terms, after inflation terms, that is meaningfully higher than whatever the returns we're getting on our balances, we're going to be eroding it, right? This is just the mathematics of it. And if you are trying to have enough money to have a secure retirement for many decades, and potentially, as was mentioned earlier, to handle the possibility of a health shock, right? A potentially very, very large uninsured healthcare expense. It's quite possible that spending 4% a year, which seems like a tiny number, might be problematic. So let's put that into context, right? I'd say for the vast majority of people in our country, and we're fortunate to be in a prosperous country, the idea of being a millionaire is an incomprehensible one. To actually have $1 million or more of liquid financial wealth, and yet if you have $1 million in total retirement savings, and I would include whatever your personal Social Security balance is. If you have $1 million and you're spending 4% of that a year, you're spending $40,000. And that is, about 75 to 80% of the average household income in this country. And so you're just about replacing, what feels like the right amount for the average household income in this country. And yet it's a sum of money that is literally incomprehensible to the great majority of us. And so, this is the problem. The question isn't, is it 4% or 3.5% or 5%? Is that you need an enormous balance against which you can spend that rate. And then there is some risk in the current environment of very low inflation and potentially lower returns, nominal returns, and real returns in capital markets going forward, that spending at that rate could begin to eat away at your savings. And if you do confront a healthcare shock, an expense that you're simply not prepared for, that you could lose money very, very quickly. So it's, it's not imprudent to spend something more in the order of 3% rather than 4% in the current environment.
And I would like to add that it's interesting to note how few people have really calculated how much they need to save for retirement. EBRI has a retirement confidence survey that year after year finds that fewer than half of workers have calculated how much they need, and how much they can spend in retirement, how much they need to save for retirement. There's some very chilling focus group footage that I saw from the Society of Actuaries, where they had videoed people who were in retirement and talked about their decision to retire, which was, very little thought went into the whole process. People were saying that, it just felt like it was about time. They hadn't really calculated how long they thought they were going to be in retirement or how much they thought they needed. It just felt like, 65 was the right time to retire. And so I think we could also challenge not only the 4% drawdown rule, but whether age 65 is the right time to retire. People are living longer. They're healthier at age 65. They're more vibrant. They probably can work a little longer. And not only for financial reasons, but thinking about it in terms of quality of life, keeping active, keeping engaged. I think those are other things to consider when considering the right time to retire, and whether 65 is the right time, just because that's the number we always hear.
Yeah, I saw a very interesting study a few years ago where the authors were comparing cognitive function among older adults across countries. And the variation they were looking at is at what age do those countries' pension laws encourage retirement? So some countries encourage later retirement dates than others. And it turns out that in countries where the laws encourage later retirement, those are also countries where the elderly have better cognitive function. And so there is perhaps an element of use it or lose it in our brains. And we might question whether it is a good idea for people to be spending the last 30 years of their lives not engaged in productive employment. And to think about financing a 30-year retirement with a 40-year working life, and that's going to require some tremendous savings rates to really sustain that. Now, an economist would say that if you're afraid about living your savings and you think that your savings aren't giving you a big enough return, you should buy a life annuity, because a life annuity will give you a paycheck, a regular paycheck for the rest of your life, and you get a higher return because the people who die early will subsidize the people who die late, and so it's kind of a win-win-win. Is a life annuity the way to go in these zero interest rate times?
I've seen the product offer. I think it's an interesting proposition. The problem from the employee point of view or the investor is that yes, they want the safety that brings knowing that they have this for life, but they don't like the possibility of the insurance company keeping the money if they die early. I mean, and there's a balance there, and they have to understand that. As long as they're willing to be in that pool and say, hey, I'm sharing my money with someone else on a pool. If I outlive them, I get part of their money, but if they outlive me, they're going to get my money. I think it's a very good solution.
I do think there's a big psychological barrier where people think about these life annuities as actually riskier in some ways. So an economist would think of life annuities as an insurance product. It's insuring you against outliving your savings, but I think somehow it gets framed as this is a bet on my lifespan, and if I live longer, then I've won the bet, and if I die early, I've lost the bet, and the insurance company has gotten a whole bunch of my money.
By the way, that's an economic equivalence with what we had in traditional pensions.
For sure.
In any pooled risk setting, there's those who benefit from living longer than others. But in the DC world, where we're going from pooled risk to individual risk, once you introduce something like an annuity structure, I'm thinking about it as me versus the other guys, whereas I never thought about it that way when I was just part of a general pension pool. I think one of the issues with annuities is pricing. That it's how much with insurance, it's always is the benefit, is the payoff worth the price, and annuities tend to go through cyclical pricing phenomena like many other insurance products. So if you're smart enough to buy annuities at a point in which they're structurally underpriced, they can be very, very valuable. I think one of the other issues with them, which I hope the insurance industry and the investment management industry collectively work to solve, is the counterparty risk. That that I think in the wake of the financial crisis and the realization that big companies can have some very serious difficulties, they have to be bailed out. I'm not sure I want my retirement savings being held by a single company. I like the idea that it's that it is insured, protected in a broader way. So we're just in the earliest stages now of seeing annuities become embedded in target date funds, which I think is a fascinating innovation, with the idea that rather than buying bonds over time and reducing equity exposure, money, instead of going into bonds, is gradually buying into life annuity. It's a very interesting innovation, not at all widely adopted because of, among other reasons, concern that there's a single insurer counterparty risk on the other side of it. But I think with further work, this has the potential to be an important step forward.
And I would say there's another compromise out there that's kind of interesting in its inception stages, which is longevity insurance. So this is insurance that you purchase an annuity at age 65 or even before then, that doesn't kick in until age 80 or 85. It's less expensive, and it solves the problem of the time horizon problem, because now you have your nest egg that you can spend down or spend as much as you want to of it through age 80 or 85, and then you've got the safety net of the annuity that kicks in should you live that long, and that could be a nice solution. It's in the very early stages in terms of product development, mainly because longevity insurance has not fit very well into defined contribution plans because of issues around required minimum distributions. Interestingly, the Treasury Department addressed that with some regulation last year that I think has spurred the industry to begin looking at longevity insurance again as a possible solution that does fit into defined contribution plans. But to Mark's points about counterparty risk and a lot of these other considerations that keep plan sponsors from wanting to offer any kind of annuity in a plan, that still needs to be addressed. And we're seeing the Department of Labor beginning to get into the fray and looking at this as well, and possibly doing some kind of safe harbor that might help plan sponsors, at least, with those types of concerns.
Yeah, I agree that counterparty risk is a huge consideration in this market. You're thinking about a 30-year horizon, and think about all the things that have happened in the last 30 years, the financial crises and just the crazy stuff that's happened. And who knew that Lehman Brothers and Bear Stearns would be gone? These seem like kind of institutions that would be around forever. And do I really want to be dealing with my counterparty going bust when I'm 85 years old and maybe suffering from some health problems? So I'll actually reveal something quasi-personal here, and I promised I was not kind of prompted by our administration to say this, but when I retire, my plan is to actually go with a charitable life annuity, and I would give my money to an institution like Yale, because I think that Yale is one of the best counterparties that are out there. I think that the probability that they would default on their commitment is extraordinarily low, and kind of between the tax benefit and that counterparty risk being extremely low, it seems just like a worthwhile financial investment, having nothing to do with how much I do or don't love Yale. I do love Yale. Let me take just one more audience question, since we're running short in time, and I'm not sure how much you guys know about this particular market, but one of our audience members asks, when does it make sense to invest in long-term care insurance? You guys thought about this at all?
As any other insurance product, I mean, I've seen the need for it. If you're planning to invest in it, it's better to invest in it earlier rather than later because it's just going to be increasing. Now, having said that, you have to evaluate, is it better to, instead of start investing in it, saving, and if you have the discipline, can you save enough and cover for yourself? That's part of the individual decision making in there. But if you're planning to invest, it's better to do it earlier rather than later. But always weigh it against just what can you do on your own if you have the discipline.
Yeah, I think with long-term care insurance, I also worry about counterparty risk. My understanding is that the market is a little bit dysfunctional, although I've not kind of reached the age where I'm worrying about this quite yet. Let me move on to another question about, in the last 5 minutes, about just a very practical question. How can an ordinary person figure out whether he or she is on track for an economically secure retirement?
I think the good news is that according to a survey that we did last year, 70% of plan sponsors say they already provide a retirement income projection to plan participants. This is becoming very popular to show on a website or a benefit statement the projected income in retirement that people might have. And even I've seen where they will show, what you would need to save in order to get to an 80% income replacement level or whatever the assumption is, and prompt people to save more if they need to, if there's a gap there. And we're seeing again some interest by the regulators in shifting this conversation to retirement income oriented, because when people think about as Mark indicated, when they think about $1 million, that sounds like a lot of money, but when you start putting it into a monthly income in retirement, that can really be sobering in terms of how little or how far really $1 million will go over the course of retirement. So there are a lot of tools that that people have at their disposal. Often you can just go onto your plan sponsor's website and they'll have tools that will help you calculate how much you need to save and have in retirement. And the EBRI Retirement Confidence Survey pointed out that when people do a calculation that tells them how much to save for retirement, these individuals do tend to be more confident. And I think it's more than just feeling better. I think it's because they're focusing on it, and perhaps that's causing them to save more.
And just a word of warning: be realistic. We offer that as a plan sponsor, a retirement income calculator. But I've seen participants that go in and put their assumption, and they say, "Oh, I'm saving 5%. That will not be enough. But if I get a return of 10%, then it will be enough. So I just need to get that 10%." Well, that 10% return on assets is not realistic. So try to put realistic assumptions in whatever you're trying to project to see if you have enough or you're saving enough for retirement.
I'll just add that I think that there's no substitute for having some kind of a plan, and I think the empirical research bears this out. And my advice would be that you just should create a little spreadsheet. I mean, I understand that that's a difficult thing for many people, but I think that if you can just create a spreadsheet, one row per year from now until retirement, and just put in what do you think you're going to save each year, and then assume a fairly conservative return. So for my personal financial planning, I assume a 1% per year return over inflation, and see, what am I going to be at age 65? And then if I draw down 4% or 3% of my nest egg starting from my retirement age, what's that annual income flow going to be? And this is really just a little bit of arithmetic, nothing complicated. And I think that just provides a nice reality check on whether you are on track. So we're coming to the end of the hour, so I want to thank all of our participants on the panel, and also our audience members for joining us, and wanted to wish you all a good afternoon.
Thank you.
Thanks.